Hi everyone, I'm Mike Stafford, Senior Risk Trader at Flagship Energy, and this is Flagship's market update for December 2025. This month, as ever, we'll be unpicking geopolitics, supply and demand fundamentals and technical indicators, and taking a strategic level view on market movement over the last month. Now, since our last update in November, could be forgiven for thinking that a dam had burst. After a slow and steady downward trend over the course of H2 2026, the period beginning on 20th of November saw a strong bearish movement. Gas for delivery during January 26 dropped 11 pence a therm, between a high of 81 pence on the 21st of November to a low of 70 pence by the close of 4th of December. UK power for delivery in January 26 fell from £87 a megawatt hour to 79 over the same period. The gas contract for Q1 26 specifically set several successive fresh all-time lows during that same bearish movement. Further along the curve, the scale of downward movement was less significant, but the trajectory was similar, as prices dropped to levels not seen for a considerable period of time. Geopolitics provided perhaps the most eye-catching headlines over the last month, but this is a supply and demand story, so let's start there. The LNG surge we discussed in our last update is now firmly making itself felt in export statistics. In October of 2025, the US became the first country ever to export 10 million metric tons of LNG in a single month, with export volumes from the US hitting 10.1 MMT in October, with that surge led by Venture Global's Plaquemines plant and the ramp-up of Cheniere's Corpus Christi Stage 3 project. That record was short-lived, blasted out of the proverbial water by 10.9 million metric tons of exports in November of 2025. Europe remains the key buyer of US LNG volumes, taking 70%. From the Gulf of Mexico perspective, price signals as December began continue to favour shipment to Europe over the Northeast Asian markets. That November export record will almost certainly be broken again, repeatedly over the coming months, as Golden Pass LNG begins to ship cargoes in Q1 of 2026. Now, this month saw regulatory approval for a cool-down cargo at the near-completed facility in Texas, with the cool-down process likely to last 2 months before the first LNG cargo is shipped. UK and northwestern temperature forecasts as we head deeper into December are unseasonably warm. In the UK, daily average temperatures are currently due to peak during week commencing 8th of December, at levels just under 6 degrees Celsius above seasonal normal, and to remain comfortably above average relative to the time of year until at least the 19th of December. Gas for heating demand forecasts over that period are, as a result, well below what might normally be expected during the mid-December period, with some forecasts suggesting gas burn for heating of up to 100 million cubic metres a day less than typical relative to time of year. At this point, it is worth noting that post-crisis heating habits seem to have permanently changed. The height of the energy crisis saw consumers cut their demand in response to historically high prices. Price may since have fallen, but demand destruction remains. Thermostat guarding fathers and business owners everywhere play a heroic role here, helping to suppress demand and tip the balance of supply and demand a little more in the nation's favour. Wind forecasts look similar as we head towards Christmas. As of recording, the latest expectations for wind output show the UK bettering seasonal normals consistently until at least the 21st of December. This is a marked contrast with the Dunkelflaute periods we saw across Europe last winter, which contributed to a bullish start to 2025. As that calendar year draws to a close, with both a surge in wind outputs, daily temperatures and LNG exports, looks like giving us a bearish finale. Geopolitics did also contribute to the bearish movement. On 19th of November 25, US news website Axios reported that US envoy Steve Witkoff had developed a 28-point plan alongside Russian envoy Kirill Dmitriev, proposing, among other measures, a ceasefire along the existing front line, a reduction in the size of Ukraine's military but not Russia's, and a ban on Ukraine ever joining NATO. While the plan was widely criticised, including by the US's own Secretary of State Marco Rubio, its existence did allow bears in the market to once again talk up the possibility of piped Russian gas flows returning to Europe in some capacity. As November progressed, talks continued, with diplomats and elected officials from the US, Russia, Ukraine, the EU and the UK meeting in various combinations to discuss potential peaceful solutions to the conflict. However, on the 2nd of December, Russian President Vladimir Putin made belligerent remarks about a wider war with Europe, and as of 8th of December, Russia had not relented from its long-held maximalist demands. It is reasonable to suggest that the return of piped Russian gas flows to Europe remains in the high-impact, low-probability section of a risk management matrix. In the early hours of Wednesday, the 3rd of December, the European Union agreed a deal to phase out Russian gas imports by late 2027. Representatives of European Union governments and the European Parliament formally agreed to move forward with plans first put forward in June of 2025. The agreement would see the end of LNG imports from the end of 2026 and pipeline gas from the end of 2027. In contrast with the bearish narrative about Russian flows returning, the EU's own press release in the wake of the agreement was resolute, stating that by November 2027 at the latest, the EU will phase out once and for all Russian gas imports. Of course, it's worth pointing out here that the disappearance of the EU as an export market for Russian gas does not mean Russian gas becomes a stranded asset. In early December, Gazprom CEO Alexei Miller confirmed that Russia's total gas exports to China via the Power of Siberia pipeline are projected to surpass 38 billion cubic meters in 2025, marking a significant milestone in the 30-year, $400 billion contract between Gazprom and China National Petroleum Corporation. Export records were set for 4 consecutive days on December 1st, 2nd, 3rd and 4th. Deepening energy ties between Russia and China have helped Russia replace the European export market. A more intriguing development came on the 4th of December, when Turkey signed a year's extension on pipeline imports of Russian gas. Turkey is Russia's last major European market for pipeline gas, and imports 22 BCM per annum through 2 pipes under the Black Sea south of Ukraine. However, amid the rise in US LNG liquefaction capacity, Turkey has diversified its import portfolio, with imports from Russia now amounting to less than 40% of Turkey's overall gas mix. Turkey's state gas importer, BOTAŞ, has signed a series of long-term LNG contracts, with the country committing to buy 1,500 cargoes from the US over the next 15 years. With 3 floating storage gasification units and 2 onshore LNG gasification terminals, Turkey is already one of Europe's largest LNG importers, alongside France, Spain, the Netherlands and the UK. From a technical perspective, the recent sharp downward movement has taken UK gas and power markets deep into oversold territory. This doesn't mean that markets have hit a long-term bottom, but that a rebound in price may be forthcoming. However, as I mentioned earlier, the depths of the global LNG glut are still ahead of us. Overall, the post-crisis winters so far have seen risk premia drop off as winter elapses. In winter 23, we saw this fairly early, with prices beginning to drop in December and continuing to fall well into late February. In the winter of 2024, it was mid-February before the decline began, with the fall arriving around Valentine's Day. Supply and demand fundamentals heading into winter 25 suggested we should expect downward movement, but January and February 26, the coldest months of the winter period, are yet to come. Recent bearishness is welcome, but no pun intended, the UK is not out of the woods. As 2025 draws towards a close, it is also worth pointing out just how much the backwardation we saw in markets at the start of the year has been squeezed by the recent bearish moves. Bearishness has predominantly dragged down the value of contracts for delivery in the near term. So front month, Q1 26, summer 26 and winter 26. While contracts further ahead have also shed value, they have done so less aggressively. To put some perspective around this, on the first trading day of 2025, the price difference between the summer 25 and summer 28 gas contracts was 67 pence a therm, with the near-term contract all but double the more distant one. After the sustained bearishness over 2025, the difference between the front summer, i.e. summer 26, and the summer 3 years hence is now just 6 pence a therm. This throws procurement and hedging strategies into sharper focus. Going forward into 2026, it's no longer going to be enough to simply bag the win associated with hedging at a lower price this year than was available last year. Navigating this new environment will require expert guidance. So if you'd like to discuss our market outlook and guidance further, please do get in touch on the details that follow.